Yeah, well, I think there's really two types of opportunities the way institutional investors look at it. There is acquisition of opportunities in renewable energy that are a reflection of the stock of renewables that have been built up over the years. So tens of billions of dollars have now been invested, and a lot of those assets are trading hands. So that sort of fits into the infrastructure allocation for a lot of the world's institutional investors. And on the other hand, there's the new asset creation part, which really a higher return, let's say somewhat higher risk. Emerging markets is one of the largest opportunities in the world, but even in the United States now, with all of the coal-fired capacity being retired and all the old oil and nuclear plant, that's a tens of billions of dollars of opportunity right there, even in a market like the United States. Well, if you look at one of the world's most competitive power markets, is the US, and particularly because gas is so cheap in the US. So we've seen electricity prices fall there significantly over the last 5 years since the shale boom. Now, even in the United States, large-scale wind and solar is competing at half of the rate that conventional power generation is trading at. And new build gas, new build coal can't even get close to competing to the rates that we're seeing. We're seeing wind at 1.5 cents a kilowatt hour. Being contracted under long-term contracts. That's unprecedented. And so even in a market like the United States, if you can be that cost competitive in large-scale wind and solar, imagine how attractive that is in a place like Mexico. So in Mexico, power was trading at 36, 38 cents when it was controlled by the central utility, the CFE. We're seeing new projects being done at 2 and 3 cents. That's the sort of level of impact that we're seeing renewables having on power generation around the world. We think of storage really, it's really an arbitrage, it's a time and value arbitrage, and it's essentially taking power that's generated at a cheaper moment of the day or the week or the month or season, and it's allowing it to be used at times when power is more expensive, and these days power in deregulated markets is on a supply-demand, right? So therefore the price varies and it fluctuates. So batteries have a particular utility in markets that can accommodate a lot of solar, particularly during the day. So a place like California, Arizona, Texas, Florida, Australia. Some would say not the UK, but there's still a lot of solar here in the UK. That's really where, in the near term anyway, it has its most natural application. And so by being able to take what we call a time shift, so take excess solar generated during the day and be able to deliver it into the early evening peak, is probably the most obvious high value application for batteries. Beyond that, they have a very significant role to play in homes, businesses. Eventually, when the technology, a little bit like solar modules, gets cheap and we're comfortable that it's safe and we know it's serviceable and the warranties are good, that's when we'll see a large-scale rollout when homeowners will be able to do that themselves. They'll be able to time shift the solar and be able to reduce their dependency on the grid. So I think that's not only going to change power markets and change the way electricity is priced, but we're going to see a very significant proliferation of battery storage infrastructure, which is an investment opportunity in real assets in and of itself. Well, I think the Clean Trillion was always originally intended as a bit of a wake-up call around not just the scale of the opportunity that exists in decarbonising power systems as part of the climate challenge, but then trying to translate that into dollars and cents opportunities for institutional investors. And so the bulk of the capital that needs to be deployed into these new assets will come from the world's pension funds and insurance institutions and some of the sovereign wealth funds. And that report and the work that Ceres did and is still ongoing is really around investor education and investor awareness. Here's how big the opportunity is. Here's where the pockets of that opportunity are. These are the sorts of risk-adjusted returns that you can expect. And you should be thinking about this from a strategic asset allocation perspective because it's here and now. And so that is really a lot of the intention behind the Clean Trillion. Use a big number because it is a big number. Get institutions' attention, get them focused on it, get them understanding where they might want to play in that, right? And then that's really just the tip of the iceberg. But this is the second follow-up report to the first one. and it was getting a little bit more granular because the market has matured and moved on. We were able to get into a lot more detail around risk-adjusted return and different investment strategies.